Hey guys, in this lesson, we're going to learn about deferred revenue. Deferred revenue is the value of money received in advance for goods and services that the company has not yet provided. Another way to look at deferred revenue is that it's the value of goods and services that the company owes to the customers. It has already been paid for whatever it sells, but it hasn't provided the product or service yet. So it owes an obligation to provide these products and services. If a company has $10 million in deferred revenue, it means that the customers had paid $10 million for the company's products and services, but not yet received them. The company is obligated to provide these $10 million worth of goods and services that they were paid for. Essentially, deferred revenue is created when businesses get paid first and provide goods and services second. This is a very common revenue model for many businesses across the world. It's basically the polar opposite of accounts receivables. Whereas accounts receivables represents the amount of goods and services provided and cash payments yet to receive, deferred revenue represents the cash payments received, but the goods and services yet to be provided. Say, for example, you subscribe to Netflix for $9 a month. You pay $9 to Netflix, and in return, Netflix gives you access to its TV series and movies for the month. Now, at the very moment when Netflix receives $9 from you, it's got the $9 of cash from you, but it hasn't provided the full month of access yet, and it won't be able to completely provide the service until 30 days later. Recall that under revenue recognition, revenue is only recognized when a core product or service has been delivered. Netflix got the cash payment, but hasn't provided the service yet, so it has to record a deferred revenue on its balance sheet. It's obligated to provide the service to you worth $9. If all businesses get paid at the same time products and services are provided, then deferred revenue wouldn't exist. But in reality, there's often a time lag between when products and services are provided and when payment is received, which creates balance sheet items like accounts receivables and deferred revenue. Deferred revenue are generally settled in less than a year, meaning that companies generally deliver their products and services within a year of receiving payment. So deferred revenue usually appear under current liability. Naturally, some people might ask, why is deferred revenue considered a liability? Deferred revenue is a liability for the business because it represents the value of goods and services that the company owes to its customers. So debt represents what the company owes to its lenders. Deferred revenue represents what the company owes to the customers. In the next lesson, we'll learn about accounts payable, which represents what the company owes to its suppliers.